Welcome to Trading Nation. I'm Sara Eisen. The 10-year Treasury yield hitting 3%, the highest level since January 2014. So let's take a look at some of the highest yielding names in the S&P 500. Check out names like AT&T, BP, Philip Morris, all boasting dividend yields of 5% or more. Are any of these names worth a buy? Stacey Gilbert is with Susquehanna. Matt Maley is with Miller Tabak. Stacey, what do you think of that strategy?
Yeah, so one of the things I think in general about owning a stock because you like the dividend yield is it's really tough because as stock goes down, if the dividend doesn't change at all, the yield sounds a lot better, but you've lost more of your capital that you put in. So just looking at the dividend yield, obviously not the best strategy to do. But if you are looking at similar companies and one happens to have a higher dividend yield than the other, obviously that can be a compelling argument. When we look at options, what's really fascinating about options is as an options owner, you are not entitled to own a dividend. So you have to actually exercise your calls to become a shareholder to be entitled to any dividend a company might pay. What allows us to really interpret from that is we can see what the expectation is in the marketplace for future dividend payments. So if a company is rumored to be potentially cutting a dividend, we would see that type of trading within the option space. Same if a company is expected to increase a dividend. And of those three names that you mentioned, I will say that there does not seem to be any concern right now, at least in the going out a year within the option space, that these companies are going to cut their dividends. So if it's a name that you like and the dividend yield's attractive, we're not seeing at least anything in terms of market positioning currently that these yields are at risk for the actual dividend payments themselves.
Well, that's a good point. But still, Matt, typically when you see rising Treasury yields, you see the big dividend payers sell off. They're just not as attractive. What are you seeing in the charts, though, right now?
Well, first of all, just one thing that Stacey mentioned about just because it's a high dividend doesn't mean it's a great stock. That's why it's so important to look at a company's dividend growth, if they've been growing their dividend consistently over years. But as for the specific names you mentioned, there's two of them stand out, and they're exact opposites of one another. First of all is Philip Morris. The stock is broken down badly. I mean, it made a key lower low today, breaking below its 2016 lows. But not only that, it's broken below its trend line, going all the way back to the 2000 credit crisis lows back in 2009. So this is a double whammy for the stock. Now, it's a little oversold on a near-term basis, so it might bounce. But this is a broken chart, and it's be one that I would sell on any kind of strength, any kind of near-term strength. As for the one that looks really good, it's just the opposite, is British Petroleum, BP. The stock has seen a nice rally, a series of higher highs and higher lows, and made an important higher high above its January highs of this year. So that's very positive. But more importantly, it's above its trend line going all the way back to 2007. So you break a 10-year trend line and make a nice higher high. That's a very bullish sign. Again, a little overbought near term, but there's a stock I'd want to buy on weakness rather than sell on strength.
All right, Stacey and Matt, thanks for joining us today. And thank you all for watching Trading Nation. I'm Sara Eisen. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.